If you are buying a home this year, you are about to pay more just to have your credit checked. And a United States senator is now demanding to know why. Meet Donna. She is a first-time buyer, and the fee just to check her credit came in higher than what her sister paid last year for the very same thing. What if the number that sets your mortgage rate now costs more just to look at, and no one warned you? Today we walk through what happened following Dana as her credit fees keep climbing, what the senator actually did, why FICO can charge this at all, how it lands on you at closing, and what you can do about it. Get this right and you sign your loan knowing the game. Get it wrong and you pay a fee you never saw coming. By minute 4, you will know whether this hits your loan, and stay past the 5-minute mark because one number in this story quietly does the most damage to your wallet. Point 1. A sitting senator opened a formal investigation into FICO. On March 23, 2026, Senator Josh Hawley of Missouri sent a letter opening an investigation into FICO, the company that makes the credit score most mortgage lenders use. He also urged the Federal Trade Commission, the FTC, to open its own look. The reason is simple. The price of a credit score for a mortgage went up sharply, and he wants to know why. Here are the numbers at the center of it. For 2026, FICO set its wholesale mortgage royalty at $10 for each tri-merge score. In 2025, that same royalty was $4.95. So the core price roughly doubled in a single year. The senator went further back. In his letter, he said FICO raised the per-score mortgage royalty from about 60 cents to $10 over the last 5 years. He estimated the increase could cost the mortgage industry around $500 million, from about 60 cents to $10 in 5 years. That is the jump that got a senator's attention. Dana felt this without knowing the cause. When she pulled her file to get pre-approved, the credit fee on her paperwork was higher than what her sister paid last year for the very same thing. Point 2. Why can one company raise a price like this? Because almost every mortgage lender uses its score. FICO scores are used by roughly 90% of lenders. That is close to the entire market. When a lender decides your mortgage, they usually pull what is called a tri-merge report, your credit from all 3 major bureaus, each with a FICO score attached. That near total usage is the point the senator is pressing. If a product sits in almost every mortgage file and buyers cannot say no to it, then raising its price is very different from raising the price of something you can shop for. When 90% of lenders lean on one score, there is nowhere else for a buyer to go. FICO did offer a second option for lenders. Instead of $10 per score, a lender can pick a different plan. $4.95 per score, plus $33 per borrower on every loan that actually closes. Same company, 2 ways to pay, and lenders are still doing the math on which one costs them more. For Dana, none of that choice is hers. She does not pick the score, the plan, or the bureau. Her lender does all of that. She simply receives the bill, folded into her costs. Quick pause. If this is the kind of clear, no-fluff credit breakdown you wish somebody had shown you sooner, hit like and drop a comment below. I read every comment and reply personally. Share this with anyone shopping for a mortgage right now, and don't forget to subscribe because we put out several new videos every week. Drop a comment with the state you are buying in and whether your lender has ever told you what your credit pull actually costs. We want to see where our viewers stand on this. Point 3. How this actually reaches you, the buyer. The short answer is that it gets baked into your closing costs. You do not pay FICO directly. You pay it inside the fees on your loan. When you apply for a mortgage, there is a line for the credit report. That fee covers pulling your reports and their scores. When the wholesale price of the score goes up, the resellers who package these reports charge the lender more, and the lender passes it straight to you. Resellers in the mortgage business reported that their combined credit report costs rose by roughly 43 to 50% going into 2026. That is not the price of your whole loan. It is the price of one line item, but it is a line item on nearly every mortgage in the country. A single fee on almost every home loan in America, going up by nearly half. Now, is this the biggest number on your closing statement? No. Next to your down payment or your rate, a credit fee is small, but the senator's concern is not only the size, it is that a price buyers cannot avoid went up this fast, this quietly, with no competition to hold it down. Dana's takeaway is honest. The fee itself will not break her budget. What bothers her is that no one explained it and she had no way to shop it. Point 4. What happens next and what you can actually do about it. This fight is really about competition, and there is already a challenger waiting in the wings. For years, the main alternative to FICO has been a score called VantageScore, built by the 3 credit bureaus together. Regulators have been opening the door for lenders to use it more widely in the mortgage market. More competition is the kind of pressure that could keep any one score's price in check. But that is the big picture. Here is what is in your hands right now. 1. Know your score before you apply, so no number surprises you. You can often see your FICO or your VantageScore free through your bank or your card app. 2. When you shop lenders, ask for the full loan estimate and read the credit and third-party fees, not only the rate. Shopping lenders is still your strongest move because the fees around the loan are not all the same. 3. Keep this in proportion. The investigation is just that, an investigation. The senator asked questions and urged the FTC to look. FICO has defended its pricing as reflecting the value its score provides. Nothing here changes your loan on its own. It is a signal to watch, not a rule that just passed. For Dana, the plan is simple. Know her score, gather loan estimates from more than one lender, and read every fee line before she signs. That alone puts her ahead of most buyers on her block. All right, let's lock this in. Point 1. A senator opened an investigation into FICO and urged the FTC to look after the mortgage score. Royalty was set at $10 for 2026, up from $4.95. Point 2. FICO can move that price because its scores sit in about 90% of lender decisions. Point 3. The cost reaches you baked into closing fees, with resellers reporting jumps of roughly 43 to 50%. Point 4. The real issue is competition, and your best defense is knowing your score and shopping your lenders. One score, near total usage, a fast rising price, and now a senator asking why. None of this is about panic. It is about walking into the biggest purchase of your life with your eyes open, knowing every fee, and refusing to be surprised. If this helped you, give it a like and drop a comment below. I read every single comment and reply personally to your questions. Send this to someone who needs to see it, and make sure you subscribe, because we put out several new videos every week. And the next video you should watch is our breakdown of how to raise your mortgage score fast in the weeks before you apply. Even a small bump can drop your rate to a cheaper tier. Make sure to subscribe so you don't miss it. It'll be uploaded within the next 2 days. See you there.